Hey traders, welcome back to NFTraderr. If you've ever felt like price action is deliberately hunting your stops, today's video is going to flip that script. We're zooming out to expose the liquidity loop that powers every surge, pullback, and fake out on your chart, from the stop hunt highs and lows outside the range to the fair value gaps and inverse gaps hidden inside it. By the end, you'll understand exactly where institutions enter, exit, and flip the market in their favor so you can trade with them instead of against them. Alright, let's dive right in. The very first thing I focus on when I open up a chart is what's happening outside the current price range, what we call external liquidity. Why is this important? Because identifying where that liquidity lies, just beyond recent highs or lows, gives me a serious advantage in anticipating the market's next move before it happens. So what do we mean by external liquidity? Simply put, it's the pool of orders sitting just outside the range the market is currently trading in. These areas often attract price because they hold either buy-side or sell-side liquidity, sitting above key swing highs or below major swing lows. Let's quickly unpack what we mean by buy-side and sell-side liquidity, starting with buy-side. Buy-side liquidity refers to the collection of orders sitting above the current price in the market. Take this swing high, for example, it's a hotspot. Why? Because that's where short sellers have placed their stop losses, and breakout traders have stacked buy stop orders, all ready to be triggered if price pushes higher. When price reaches that area, a wave of buy orders hits the market, stops are taken out, breakout entries activate, and suddenly, there's a burst of buying pressure. But here's the key, that's exactly where institutions are waiting. Not to buy, but to sell. They use these liquidity pockets as ideal exit points to offload large positions at favorable prices. So while retail traders are buying into the move, smart money is selling into the hype. Now let's talk about sell-side liquidity. Sell-side liquidity is found below the current market price, and it includes both external and internal liquidity zones. For instance, take a look at this fair value gap sitting beneath the price action. This area signals an imbalance, a lack of efficient trading, which often acts like a magnet for price to come down and fill that void. Then there's this swing low right here, a classic liquidity target. It's where long traders typically place their stop losses, and where sell stop orders tend to build up. So what happens when price dips into these areas? A chain reaction. Sell orders get activated, pressure builds, and the market drives lower. But here's the twist, while retail traders are getting stopped out or caught in the move, smart money steps in to buy at a discount, using all that freshly tapped liquidity to their advantage. Grasping the concept of buy-side and sell-side liquidity is a total game changer. It reveals where the smart money is targeting orders and how they manipulate price to fill their positions. Once you understand how the big players operate, you stop reacting and start anticipating the market's next move with precision. Take a look at this example. These highs and lows. That's your external liquidity, prime stop hunt territory sitting just outside the current range. That's where retail traders get targeted. Now, notice these fair value gaps forming inside the range. This is where we find internal liquidity areas where price keeps rebalancing and institutions are quietly filling their orders without drawing too much attention. Price starts with a strong bearish drop, aggressively falling toward external liquidity, which in this case is sitting just below a previous swing low. As price reaches that level, boom, liquidity gets swept. All the stop losses and sell stops clustered beneath that low get triggered, giving the move even more momentum. But here's where things get interesting. After collecting that external liquidity, price doesn't just keep crashing. Instead, it pulls back, and where does it go? Right back into a fair value gap left behind during the initial drop. That's the market rebalancing, tapping into internal liquidity to restore efficiency in the move. Once that imbalance is filled, the cycle continues. Price starts reaching outward again, targeting the next external liquidity zone, maybe another swing low, maybe a key support level. And just like before, it sweeps that liquidity, then pulls back again to revisit new internal imbalances created during the second leg down. This is a full liquidity cycle in action: sweep external, rebalance internal, and repeat. It's the natural rhythm of how smart money operates. And once you learn to identify this pattern, You stop getting faked out and start trading with precision. But here's the real question. Where is price heading next? Will it continue lower to grab more liquidity below? Or retrace higher to tap into fresh imbalance above? So how do we figure out where price is likely to go next? There are a few key approaches, but it all starts with analyzing order flow. This is where things get really interesting. The first item is order flow direction. Begin by zooming out and reviewing the higher time frame structure. If you're staying on the same time frame, at least take note of the recent order flow direction. Here's the logic. If price has been consistently pushing lower, forming lower highs and lower lows, then chances are that trend continues. The market will likely break further to the downside, targeting sell-side liquidity below recent swing lows. But if price has been climbing, showing higher highs and higher lows, then your expectation should shift. Price is probably making a move toward buy-side liquidity sitting above key highs. In short, reading order flow gives you an early clue into what the market might do next. The next, and arguably even more important way to forecast market direction is by observing how price reacts when it enters a fair value gap. If price respects the gap, meaning it pauses, rejects, or bounces upward, that's a strong clue that price is likely heading toward upper external liquidity. It's showing that buyers are stepping in, and that area is acting as a support zone. But if price disrespects the gap, slicing right through it with little to no reaction, the story changes. That fair value gap now flips its role and becomes what's known as an inverse fair value gap. In this context, it acts more like a resistance zone. When that happens, it often signals a shift in control and increases the probability that price will continue moving lower, targeting the sell-side liquidity sitting just below the most recent swing low. This behavior gives us real-time confirmation of where the market wants to go, not based on guesswork, but on how price interacts with its own imbalances. Let's do a quick recap of the inverse fair value gap so you know exactly how to use it when the opportunity shows up. Whenever price breaks clean through a key supply or demand zone without showing any respect, that zone flips its role. A demand zone can turn into supply, and supply into demand. The same concept applies to fair value gaps. For example, when price cuts right through a bullish fair value gap without pausing, rejecting, or bouncing, that gap is no longer acting as support. It flips and becomes an inverse fair value gap, now more likely to behave as resistance. So, FVG forms when price violates a normal fair value gap, closing straight through it without reacting. When that happens, the original gap switches its role, often turning into a key area where price will stall, reject, or reverse in the future. Now, take a look at this example. Here we had a bearish fair value gap, but price pushed right through it with two strong bullish candles. That created an inverse fair value gap. As price continues, notice what happens. It retraces back into that flipped zone, respects the consequent encroachment, and then pushes higher. This clearly shows how fair value gaps can transform, adapting to price behavior and becoming reliable zones for future entries or exits. Now, you might be asking, is there any way to know if price will respect a fair value gap or just blow right through it? The answer is yes. By carefully observing how price behaves inside the gap, you can get some valuable insight into what's likely to happen next. Let's break it down clearly. Inside every fair value gap, there are three key levels you should always keep in mind: the premium high, the upper boundary; the discount low, the lower boundary; and most importantly, the midpoint, also called the equilibrium. Now, of the three, the midpoint is the one that really matters. Here's why. If price comes back and respects the midpoint, showing hesitation or rejection, that's often a strong signal that the market will continue in its original direction, the imbalance is holding. But if price cuts straight through the midpoint with no rejection or pause, that usually tells us the fair value gap has failed, and price may be preparing to move in the opposite direction. In short, watch the midpoint like a hawk. It's your key to understanding whether the gap holds or flips. Now let's bring everything back to our main concept. In this scenario, when price enters a fair value gap and shows rejection from the midpoint, also known as the consequent encroachment, that's a high probability signal that price is likely to bounce upward from that 50% level. Once the fair value gap is filled and the internal liquidity within the current range has been addressed, there's a strong chance the market is ready to expand outward, targeting the external liquidity above the most recent high. But if price enters the gap and violates the midpoint without any rejection, that's a key sign the market intends to break through the gap. At that point, the fair value gap flips into an inverse FVG, now likely to act as resistance. When this shift happens, and price retraces back into that inverse gap and respects the midpoint this time, that reaction becomes a powerful confirmation that the market is preparing to move lower, targeting the sell-side liquidity below the most recent low. And that's it, traders. If you found this breakdown helpful, be sure to hit that subscribe button and turn on notifications so you never miss an update. Drop a comment below and let me know your thoughts or what concepts you'd like to see covered in the next video. Your support means everything, and I'll see you in the next one.